Hello students, today we'll take a quick revision of capital budgeting topic, okay, and then we'll take some important questions, different varieties of question on this topic. This will seriously help you with the exam, okay. So first you write down some important points relating to capital budgeting or investment decision topic. Capital budgeting or investment decision. So first you write down capital budgeting techniques. Capital budgeting techniques. Under that we have two types of techniques: non-discounting technique, non-discounting technique. Under non-discounting technique we have payback period. So what is non-discounting technique? Time value of money is ignored. Time value of money is ignored. Payback period. Payback period means time required to recover initial investment. Time required to recover initial investment. Under this write down, if cash flows are even, cash flows are even means same in all the year, then payback period will be equal to initial investment divided by annual cash flow. Initial investment divided by annual cash flow. If cash flows are uneven, then solve by calculating cumulative cash flow. Solve by calculating cumulative cash flow. So you will make table like this: year, cash flow and cumulative cash flow. Okay. So you will write year, you will write cash flows, you will write cumulative cash flow, and then you will see in which year you are able to recover your initial investment. In which year you are able to recover your initial investment. Is it right? Otherwise, initial investment can be recovered between 2 years also, right? So then you will find out the proportion, okay. We will solve one question after some time, you will see the calculation. Second, point number B, write down average rate of return. So right now you underline non-discounting technique. Under that we have payback period, average rate of return, also called accounting rate of return, or in short we will write ARR. Is it right? And how do you compute ARR? ARR is equal to average profit divided by original investment, or average profit divided by average investment into 100. So this will give you rate of return in percentage. Okay. Now write down below, average investment is equal to initial investment, half of initial investment minus salvage value, plus salvage value and plus additional working capital. Write in good handwriting. One day before the exam, read this. Is it right? So how do you take decision? Decision rule. Decision rule. Decision rule for independent projects. For independent projects, if ARR is greater than cutoff rate means target rate, desired rate, accept the proposal. Okay, and then you write down second bullet point for mutually exclusive projects. Mutually exclusive projects means either of the two can be selected. Okay, one of the two, select project with higher ARR. Select project with higher ARR. One more thing I forgot to write in payback period. Write down in payback period, if you have the space, decision rule. Decision rule, select the project if payback period is lower than cutoff period. Select the project if payback period is lower than cutoff period. Understood? And one more point, if you have space, otherwise write somewhere later. In case of mutually exclusive projects, I'll dictate, write down, in case of mutually exclusive projects, select the option with lower payback period. Select the option with lower payback period. Okay. in accounting rate of return, you written decision rule. Write one important note. Important note. This is the only method. This is the only method which uses profit for evaluation instead of cash flows. This is the only method which uses profit for evaluation instead of cash flows. So what is the special feature of this method? It uses profit for evaluation instead of cash flows. Now we have written here point number 1, non-discounting technique. Under that, next point 2, write down discounting techniques. Discounting techniques. Why they are called discounting technique? They use time value of money. They use time value of money. Hence, they are called discounting technique. Now, under that, one by one, we'll discuss. A, write down discounted payback period. Discounted payback period. Same as payback period. Same as payback period. However, cash flows are discounted to their present value. Cash flows are discounted to their present value, and then cumulative discounted cash flows. Cumulative discounted cash flows are calculated, and then cumulative discounted cash flows are calculated. Then cumulative discounted cash flows are calculated. So what will be the format here? For discounted payback period, the format will be year, cash flow, present value of cash flow, and then cumulative discounted cash flow, and then cumulative discounted cash flow. So one extra step you have to perform, PV of cash flow. Okay. So this way you will draw the format for discounted payback period. Cash flows will be given to you. First convert at cost of capital, PV of cash flow, then compute cumulative cash flow, and then find out between which 2 years you are going to recover your initial investment, and then find out the discounted payback period. What about the decision rule? Decision rule, same as payback period. Decision rule, same as payback period. That means it should be below the cutoff period. If we are evaluating independent project and between 2 or more mutually exclusive project, we will select that project which has a lower discounted payback period. So now write down point number B, net present value method. Net present value method is the most important method, which is called NPV method. NPV is equal to PV of cash inflows minus PV of cash outflows. PV of cash outflows. And what is the, write down little fast, it is in your interest only. Decision rule. If then NPV is positive except NPV is negative, reject. NPV is equal to 0, indifferent. So decision rule for independent projects. Is it right? And below that write down point between two or more between two or more mutually exclusive proposals, two or more mutually exclusive proposals, select the option with higher positive NPV. It should be positive NPV and it should be higher positive NPV. If both of them have negative NPV, then both should be rejected. Okay. So we have to first ensure the project we are selecting has positive NPV and we are comparing two or more, then it should have a higher positive NPV. Okay. Now write down point number C, profitability index. Profitability index method, also called, please write down fast, desirability factor. Desirability factor. So here the formula is profitability index equal to PV of cash inflows upon PV of cash outflows. PV of cash inflows upon PV of cash outflows. So what is the decision rule for, it's a ratio, okay. Decision rule for independent projects. So under that write, if profitability index is greater than 1, then accept. Keep writing, keep understanding. If profitability index is less than 1, then reject. If profitability index is equal to 1, then it is an indifferent situation. So profitability index and net present value method give you same conclusion for independent projects. Am I right? Because if profitability index is greater than 1, it is same as NPV greater than 0. Less than 1 is same as NPV less than 0. And equal to 1 is same as NPV equal to 0. So when you are evaluating one single project, either use profitability index method or you use NPV method, you will get the same answer. Is it right? For mutually exclusive proposals, mutually exclusive means you are making a choice. When you have to make a choice between two or more proposal, select option with higher profitability index. Select option with higher profitability index. Select option with higher profitability index in case of capital rationing situation. In case of capital rationing situation. In case of capital rationing situation. Capital rationing means resources are limited. So when you have limited resources, you will go with the option which has highest profitability index. Highest profitability index brings more inflow for every 1 rupee invested. But one more note, write down. Note, if there is no resource constraint, if there is no resource constraint, then select the option with higher NPV. If there is no resource constraint, then select the option with higher NPV, because higher NPV helps in wealth maximization. So when there is no limitation on fund, then why not to put money which gives me more surplus, more wealth maximization. Okay. So this is about profitability index. Any query? Point number D. Point number D, write down internal rate of return. Internal rate of return. IRR, popularly called IRR. So it is that rate of discount. It is that rate of discount at which PV of cash inflows is equal to PV of cash outflows. It is that rate of discount at which PV of cash inflows is equal to PV of cash outflows. You can say it is that rate of discount. It is that rate of discount at which NPV is equal to 0. It is that rate of discount at which NPV is equal to 0. Now the formula for calculating IRR is, one is you will use this interpolation method, lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate into the difference between higher discount rate minus lower discount rate. Is it right? Or there is a shortcut formula also if you want to use that. Lower rate plus present value at lower rate, present value, not net present value, present value at lower rate minus initial investment upon present value at lower rate minus present value at higher rate into difference between higher rate and lower discount rate. Okay. So what do you mean by lower rate, higher rate? So you have to make a guesswork about what can be the discount rate at which NP will be 0. So this method requires some trial and error. Lower rate means I have to make a selection of first a rate. If I get a positive NPV, I increase the rate. If I get a negative NPV, I decrease the rate. So the lower of the two rate chosen will be lower rate and the higher of the two rate chosen will be higher rate. Okay. And then you will get the IRR. Now what is the decision rule for independent projects? Write nicely. Decision rule for independent projects. Under that you write down if IRR is greater than cutoff rate means desired rate of return, then accept. If IRR is less than cutoff rate, keep writing nicely. Later on you can revise it one day before the exam, reject. And then if IRR is equal to 0, IRR is equal to cutoff rate, then indifferent. Okay. So this is how you will take decision using IRR. Now write down, in case of mutually exclusive projects, select the option with higher NPV, underline with higher NPV, because it helps in wealth maximization, because it helps in wealth maximization. Because it helps in wealth maximization. Now write down point number E, modified IRR. Modified IRR. IRR method has two limitations. Which are these two limitations of IRR method? One is reinvestment assumption. That means IRR method assumes that cash flows are reinvested at the same IRR. And second problem is multiple IRRs. In some situation you can have multiple IRRs, especially when there are many outflows in the project. You can get more than one IRR. So the purpose of calculating modified IRR, removes these limitations. Okay. Modified IRR removes these limitations. So what we do in modified IRR, steps: 1, reinvest cash flows other than initial investment, other than, don't reinvest initial investment, but in year 1, 2, 3, 4, 5, whatever cash flow you will get, reinvest cash flows at a more appropriate investment rate or cost of capital, or if the rate is given, use that rate, or you can invest at cost of capital. And then step number 2, calculate terminal value, that is total value at the end of project life, total value at the end of project life. 3, third, write down, find that discount rate at which PV of terminal value in bracket step 2 will be equal to initial investment, right? So how do you compute it? So that is R is equal to, let us call it R, is terminal value divided by initial investment, terminal value divided by initial investment to the power 1 by n minus 1. N means number of years. Terminal value means the last year total value you will get. So this is how you will compute modified IRR. Done. Write down below decision rule. Write down same as IRR. Decision rule same as IRR. Decision rule same as IRR. Any query till now? No query. We'll solve few questions and then you'll understand better. Done up to this point number capital B, write down special situations. Special situation, write down 1, capital rationing. Capital rationing means, what is capital rationing? Availability of funds is less than requirement of funds. Availability is less than requirement of fund. Everybody is going through capital rationing in his life, yes or no? Even Mukesh Ambani has got capital rationing. Availability of fund is less than requirement of funds. Therefore, limited funds have to be utilized in such a manner, write down nicely, limited funds will be utilized in such a manner that total NPV is maximized. Total NPV should be maximized. Okay. Now write down under that there are two types of projects. Keep writing in good handwriting. Any doubt, ask me. There are two types of projects. Which are these two types of projects? A. Divisible projects. Divisible projects means projects can be accepted in parts. Okay, in parts or proportion. Cost of projects can be accepted in parts or proportion. So how do you take a decision here? How to select projects? How to select projects if it is divisible project? Okay, so first you calculate profitability index. Profitability index will help you to identify which project is best. Okay, then next best. Step number 2, rank the projects. Rank the projects on the basis of profitability index. Rank the projects on the basis of profitability index. Project with highest profitability is ranked 1. Project with highest profitability index will be ranked 1. Then write down, select the project on the basis of rank till the funds are fully utilized. Till the funds are fully utilized. Till the funds are fully utilized. So first you will select rank 1, select rank 2, rank 3 till your funds are fully utilized. Okay. Any query on this now? So this is you will do for divisible projects. Okay. And then you write down next point B, indivisible projects. Indivisible projects. What are indivisible projects? These cannot be accepted in parts. This cannot be accepted in parts. Either you accept it in full or reject in full. Accept in full or reject in full. For example, a machine, a car. You can't buy 50% of the car if you have 50% of the funds with you. Okay. So how to select projects? How to select projects? Keep writing. I am asking you to write when you are watching. Right. one day before exam, 5 to 10 minutes. This is how the notes should be prepared. Okay. How to select project? First you write down calculate NPV of each project. First you have to calculate NPV. If it is given, well and good. Not given, then first compute NPV of each project. Okay. Then point number 2, select or make various combinations. Make various combinations. Make various combinations. Make various combinations of different projects within the overall availability of funds. Within the overall availability of funds. So suppose if you have 1,20,000, then you make combination of different projects where total requirement will not exceed 1,20,000. So that is called make various combination. And third step, select that combination which has highest, fill in the blanks, which has highest dash. Select that combination which has highest what? Select that combination which has highest NPV. Select that combination which has highest NPV. So after making combination, select that combination which have highest NPV. Is it right? Then write a note here. Do not consider projects which have negative NPV. If a project has a negative NPV, it will be simply rejected. It won't be considered in any combination. Negative NPV will not be considered in any combination, because if you include negative NPV, your total will fall. So do not include negative NPV projects. Simply reject them fully. Okay, they will not be considered. So this is how you solve the problem of indivisible projects. So we are doing special situations. Under that, first is capital rationing. Second, write down. Second is projects with unequal lives. Projects with unequal lives means when you are comparing two projects, which have different lives. Okay. So we have two methods to solve projects with unequal life, because we have to make them comparable. So one method is called replacement chain method. Replacement chain method. Replacement chain method. So under replacement chain method, what we will do? We will compare on the basis of same number of years. We will compare on the basis of same number of years. For example, write down example. If project A has life of 5 years. Project A has life of 5 years and project B has life of project B has life of 10 years. We will repeat project A how many times to make them comparable? 5 year, 10 year. So we will repeat project A 2 times. Very good. Okay. We will repeat project A 2 times. So you have to take LCM of both the numbers. So you will find a common life. Calculate NPV on the basis of common life. Okay. If it is 3 and 5, then 15 years we have to take. 3 and 5, 15 years. Project A will be repeated 5 times. Project B will be repeated 3 times. So normally they don't give such questions. It takes a lot of time to solve. So replacement chain method, we will have to compare them on the basis of common life. If required, repeat one or both projects. Okay. And then decision. Decision rule will be select the option with higher NPV, because now they are comparable. Select the option with higher NPV. This is called replacement chain method. This method will become very time consuming if the number of years are like 7 and 11. 77 year you have to is the common life. So normally they don't give you. They are also human beings. You are also hopefully human being. And what is method 2 here for projects with unequal life, which is what we will use, is called equivalent annualized method. Equivalent annualized method. So we'll find out equivalent cash flow. We'll find out equivalent cash flow for all the cash flows given in the problem. Is it right? How do you compute it? So write down equivalent. Please write and please revise. Teacher can only take you up to this point. Okay. Then beyond this point, it is your hard work. Equivalent annualized value is equal to NPV divided by PV annuity factor. NPV divided by PV annuity factor for a given number of years and rate of discount and number of years. So calculate equivalent annualized benefit for all the projects which have different life. And how do you take a decision? Using this method, decision rule. Decision rule A, if the objective is benefit maximization, we want to maximize benefit, then select the option with higher what? Fill in the blanks. Equivalent annualized benefit, EAB, equivalent annualized benefit. And B, if the objective is cost minimization, select the option with lowest EAC. Select the option with lowest EAC. Okay, what is EAC? Equivalent annualized cost. So sometimes the two projects we are comparing are having only cost, like whether I need to buy Activa or I need to buy Pulsar bike. Okay, so I am not going to generate any revenue from them, but I can certainly reduce my cost. So EAC or EAB gives you equivalent annual cash flow. So if it is inflow, you will try to maximize. If it is outflow, you will try to minimize. That is common sense. So this is called equivalent annualized method. Up to this you have written. Special case number 3. Special case 3. Replacement decisions. Replacement decision. What is replacement? It means selling old asset and buying a new asset. That is called replacement decision. Okay. So the issue is whether to continue with the old asset, The issue is whether to continue with the old asset or replace it by the new asset. Understood the issue involved? So under that you write down situation 1. Situation 1, what is situation 1? If the remaining life of old asset, situation 1, if the remaining life of old asset and life of new asset are equal. If remaining life of old asset and the life of new asset are equal, then calculate incremental NPV. So we will apply which method? Incremental NPV. Then calculate incremental NPV. If incremental NPV is positive, then replace old asset by the new one. If the incremental NPV is positive, then replace the old asset by the new one. And what is situation 2? Situation 2 is if the remaining life of old asset, and life of new asset are different. Possible, because old asset must have already completed certain number of years. New asset may have a longer life. Then how do you compare them? If the remaining life of old asset and the life of new asset are different, then calculate equivalent annualized value for both old as well as new asset. Then calculate equivalent annualized value for both old as well as new asset. Understood? Then how do you take a decision? How do you take a decision in situation number 2? After computing equivalent annualized value, how will you take a decision? Already explained to you. In case of equivalent annualized value method, the decision rule is, if you want to maximize benefit, go with higher EAB. If you want to minimize cost, go with lowest EAC. Is it right? So the decision rule will be same as equivalent annualized method. Equivalent annualized method discussed above. Discussed above in point number 2. Discussed above in point number 2. Same as equivalent annualized method discussed above in point number 2. So these are special situations. So this is your syllabus, okay, for capital budgeting chapter, which I have summarized in 3 to 4 pages. How many pages did you write? 6 or 7 pages. So that much is enough one day before the exam. Okay, you want to write more or you want to solve problem? So write one note and then we will solve problems. Note, write down. Note on depreciation. First is note on depreciation. So under that write down, depreciation is a non-cash expense. Depreciation is a non-cash expense. True or false? But tax shield on depreciation is cash inflow. But tax shield on depreciation is cash inflow. If there is no taxation, next note is, if there is no taxation, there is no need to calculate depreciation. There is no need to calculate depreciation. There is no need to calculate, or depreciation is irrelevant. So don't calculate only. Next point, write down, depreciation will be calculated. Depreciation will be calculated as per what? Companies Act or Income Tax Act? As per income tax laws. Income tax laws. Depreciation, suppose in some question they will give you 2 rates of depreciation, one as per books of account and one as per income tax law. We will take as per income tax law. So depreciation will be calculated as per income tax law. Okay. Then next write down, block of asset concept is followed. Block of asset concept is followed while calculating depreciation. Block of asset concept is followed while calculating depreciation. Block of asset concept is followed while calculating depreciation. Next note, write down, note on accrual versus cash basis. Note on accrual versus cash basis. note on accrual versus cash basis. So under that 2 point, profit will be calculated on accrual basis. Profit will be calculated on accrual basis. Note number 2 below that. However, CFAT will be calculated. Come on, CFAT will be calculated on cash basis, means actual timing of receipt or payment of cash. Because it happens, the question may give you that sales will be collected in the next year. Sales will be collected in the next year. So while calculating profit for income tax purpose, I will take sale in the same year. But while calculating CFAT, I will take sales in the next year. Okay. So in right here refer May 2022 question which we will discuss, that was based on this concept of cash versus accrual basis. Okay, so they can ask question from any corner. So most of the important points I have explained to you, and now some more learning will take place with the help of some important questions. So requesting you to keep the financial management book in front of you so that it will be easier for you to understand what we are discussing in the classroom. Okay, and we will practice all these questions in the notebook. So first we will start with a revision of payback, NPV and IRR. Kindly come to question number 22. Have you reached question number 22? This will help us to revise three concepts: payback, NPV and IRR. Okay, so come to question number 22. This question is there in your study material plus October 19 MTP for 7 marks. Question is, Hind Liver Company is considering a new product line to supplement its range of products. It is anticipated that the new product line will involve cash investment of rupees 7 lakh at the time 0 and rupees 10 lakh in year 1. So investment will be made on two dates, year 0 and year 1. Timing of cash flow is important in this chapter. So the 10 lakh rupees will be discounted by 1 year present value factor. Okay. After tax cash flow of 2,50,000 are expected in year 2, 3 lakh in year 3, 3,50,000 in year 4 and 4 lakh each year thereafter through year 10. Now what do you mean by this line? 4 lakh each year, underline each year, thereafter through year 10. What does that mean? It means 4 to 10 years. Each year 4, 5, 6, 7, 8, 9, 10. The cash flow after tax will be 4 lakh rupees. Is it right? 5 to 10, not 4 to 10. 5 to 10, because year 4 is 3,50,000. Although the product line might be viable after year 10, the company prefers to be conservative and all calculation at that time, which means we will take calculation up to 10 years only. Okay, maybe after 10 years they might get some cash flow, but the company says let us only assume that the product will have a life of up to 10 years only. If the required rate of return is 15%, means discount rate, desired return, target return, find out NPV, is it acceptable? So you will say it is acceptable when NPV is positive. Very easy. All data that you need is given in the problem. Second question is, analyze what would be the case if the required rate of return were 10%. Same problem. solve 2 times, one at 15% and the other one at 10%. Then again compute IRR. Oh my god, how many things we have to do. And compute the project's payback period. Is it right? Say yes or no. What is the payback period? Very easy question, bonus marks. So write down first calculation of NPV. Calculation of NPV. Calculation of NPV. So this I have to solve 2 times, one at 15% discount rate and one at 10%. Can I solve in the same table? Yes, because we don't have to write same thing again and again. Year, cash flow. These 2 column will be constant. Then write down present value at the rate of 15% and present value at the rate of 10%. I will solve without writing discounting factor, okay? Don't worry, I am with you. Year 0, 1, 2, 3, 4, 5 dash 10. You want to write factor, you can just draw one more column, easier. No problem. Because there is an annuity factor also in the last. So I will write factor also. One column for PV factor, one for present value. PV factor, present value. Okay, understandable? Write nicely. One day you have to revise also. Your own notebook. This may be sufficient for exam. So first you have to read the problem carefully. In year 0, how much is your investment? 7 lakh. Year 1, again you have to make an investment of 10 lakh. So this time be careful, you have investment made in year 0 and in year 1. Then after tax cash flow will be 2,50,000 in year 2. Very clearly written. And 3 lakh in year 3. 3 lakh in year 3. 3,50,000 in year 4 and 4 lakh each year throughout year 10, which means 5 to 10. Since factors are not given, we will write factor ourselves up to 3 digits. So take your calculator. 1 divided by 1.15 equal to, come on, reply. 1 divided by 1.15. Is it 0.870? Can I round off to 0.870? Yes, come on. 2,50,000. Okay. Again press equal to. Just press equal to, you get the factor. 0.756. Very good. Right. Press equal to. 0.657. Amazing. Next. Can we make it 0.572? Now stop. Wait. Because it is not 5. It is 5, 6, 7, 8, 9, 10. Now many students are not able to crack this factor. Wait. Please give me some chance to speak. Okay. Because if you don't know, it's better to ask instead of suffering. So how do I get the factor of 5th to 10? It means I require factor of 5th, 6, 7, 8, 9 and 10. Understand the logic? I need to add the factors of these years on my calculator. So how do I do it? So first I will take 1 divided by 1.15. equal to equal to equal to equal to 4 times. First 4 years I have already written separately here. Can you see that? Now you press equal to m plus. So that fifth year gets transferred to memory plus. Equal to m plus equal to m plus equal to m plus equal to m plus equal to m plus, and then you press that MRC function in your calculator. So you will get something around 2.163 or 4, no problem. Are you getting now? This is the way you have to get the factor if it is between 5 to 10 or anything like that. First 4 factors do not transfer to m plus. Is it right? So now why are you waiting? Why don't you multiply and add them? Just the moment you get a chance, you sit down idly. Okay, that is the problem with this students nowadays. Which is 8,70,000. Okay, it's not 10 lakh, sorry. It is 8,70,000 because it's year 1. Okay, next, the first two numbers put in bracket. 1,89,000. Okay, next one, memory plus. Use memory plus function nicely, huh? 197,400. This is 658. Make it 658. 197,400. Okay, next try. 2 lakh 200. 200 200. And then 4 lakh into 2.163. Very good. 865,200. First you add all these positive numbers. Minus 7 lakh and minus 8,70,000. Anybody wants to tell me the total of this column? Positive or negative?
Negative 1,18,000.
Negative 1,18,200 approximately. No problem. 1,18,000 is also okay.
1,18,500.
No problem. No problem. Last 3 digits can be different. But it should be negative 1,18,000 and something. That is okay. Now we'll do the same thing for 10%. If you can just reply me faster. 1 divided by 1.10 equal to 3 digits.
909.
Again equal to
0.826.
again equal to
0.751.
again equal to
0.683.
683. Now wait. On the screen below, I have written, type 1 divided by 1.10, press equal to 4 times. Now 5th to 10th time you will press equal to m plus MRC. Now you will get some factor on your calculator, which is the sum of the factors of year 5 to year 10. Good students will reply.
Sir, it is 2.974.
2.974 seems to be right. Okay. Other students will multiply now.
Sir, 7,909.
7 lakh
9,09,000.
9,09,000 in bracket.
2,06,500.
2,06,500. Very good. Come on, next.
2,25,300.
2 lakh
25,300.
25,300. Amazing. 2,39,050. Very good. And last one. 4 lakh into 2.974. 11,89,600. Dear student, you are requested to tell me NPV of the last column.
20,69,460.
2 negative numbers are there in the beginning, minus the 2 negative figures.
Plus 26150.
251,450 you are getting. Check the again. Institute answer is 251,450 positive. I would ask you to check again, because we have written all other figures same, so total must also be same.
729.
11,89,600, the last one.
Sir, 3 lakh 5,450 are.
Okay, do it carefully. You can't. 251 something is okay. 251 last three digits can be anything, still I will accept. Okay, you can't make mistake in total. In spite of all your hard work, you will get 0 marks. Question now write down here, advice. If discount rate is 15%, do not accept the project. Do not accept the project because NPV is negative. Because NPV is negative. Because NPV is negative. Write nicely. One day you have to read also. If discount rate is 10%, project is acceptable. Project is acceptable because NPV is positive. Because NPV is positive, it will increase wealth of the shareholder. It will increase wealth of shareholder. Try to practice more and more questions. Okay, so I am sure you must have understood. Such easy question they don't ask in the exam. This is the first problem for warm up purpose today. Okay, now my next question is understand IRR. Very easy, I can compute IRR. You can see on the screen when the discount rate is 10%. Can you see that? It is positive.
Positive.
But when it is 15%, it is negative. IRR is that discount rate at which NPV is 0. So my IRR would be somewhere between 10 and 15. 10 will be taken as lower rate and 15 will be treated as higher rate. So for IRR calculation, good luck. You don't have to again prepare the table. But in the exam, if only IRR is asked, first you compute the NPV at 10%. If it is positive, take 15%. And suppose it comes negative, which means you are sure that your IRR is between 10 and 15%, and then apply the interpolation formula right below. Step 2, calculation of IRR. So write down directly the formula. IRR is equal to lower rate, LR means lower rate, plus in bracket NPV at lower rate upon NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So lower rate is how much in our question? 10. We'll take 10. The one out of 15 and 10, whichever is lower, that is the lower rate. And what was the NPV at 10%? 251, 450. Then 251, 450 minus, again minus in bracket 118,200. Whatever number you've written in your notebook, you use that for NPV. Into 15 minus 10, kindly give me the answer. 13.4% approximately. always write approximately because these are based on some estimates. So this is how you will calculate IRR. Okay, so this was an example of IRR. Now write down one more step, calculation of payback period method. Payback means simple payback without discounting. How much amount we have invested in this project? 7 lakh in first year and 10 lakh in the second year. Yes or no? So we have to recover 17 lakh. So write down year. We don't have to do discounting because it is just payback period. If they would have written discounted payback period, then we will discount it. And third column write cumulative cash flow. Cumulative cash flow. So first write down year 2, 3, 4, 5, 6, 7, 8, 9, 10. Write separately because you have to take cumulative calculation every year. Okay. We have to see in which year we are able to reach 17 lakh. Okay. So year 2 cash flow is how much? 2,50,000. Year 3 is how much? Year 4 is how much? Very good. Year 5 is how much? 4 lakh. And then you keep writing 4 lakh. Understand, do not use shortcuts. There are shortcuts, but exam purpose shortcuts will not give you marks. So first you write the question as it is. Now how much we have to recover? Remember 17 lakh. So the year in which we will reach 17 lakh, my answer will be over by that time. Okay. So 2,50,000 write down here plus 3 lakh plus 3,50,000 9 lakh plus 4 lakh plus 4 lakh. Now wait, stop. In the payback period method, cash flows after payback period is not considered because my answer is over. My answer is that year in which we have recovered our initial investment. Yes or no? Yes. Right. So below that, first you write down initial investment. Our initial investment is 7 lakh in the first year and 10 lakh in the second year. So management wants to recover 17 lakh as early as possible. And therefore write down payback period is equal to, directly write down 6 years. Okay. Up to this you have done. Just one more thing I need to tell you. You have written payback period 6 years. Now write below, assume initial investment is rupees 15 lakhs. Suppose initial investment is 15 lakh. Now what will be your payback period? So this I wanted to explain. So when you get a situation like this where this is 13 lakh, this is 17 lakh, and we are assuming initial investment is 15 lakh. Is it right? So we have to find out between which 2 years we are recovering 15 lakh, between 5 and 6. It is more than 5 but less than 6. Yes or no? So it means 5 year plus 5 year minimum you have to go. You have to recover 15 lakh. You have already recovered 13 lakh in 5 years. And how much more you will get in the 6th year? You will get 4 lakh. So this 4 lakh you write here. So you will get a proportionate amount. You need 2 lakh. but the 6th year will generate 4 lakh. To get 2 lakh, you will require half year, so 5.5 years. So this way you will solve a question if the initial investment figure is not appearing in the cumulative cash flow column. Okay. So this was a question on NPV, PR, payback period and IRR. Now that was my addition to the question, 15 lakh. Otherwise, how will you learn the fraction part? Okay. So now we'll come to next question number 47. Students are requested to come to your booklet where you will find question number 47. Keep turning pages. One day you will reach 47. Okay. And that day has come. A company wants to buy a machine and two different models A and B are available. Following further particulars are available. Original cost 8 lakh, 6 lakh. Estimated life, good news, both are same, 4 and 4. So you can directly compare the NPV. Salvage value, one more good news, 0. They should not have given only. The company provides depreciation under straight line method. Tax rate is 30%. Present value of rupee 1 at 12% discounting factor and net profit before depreciation and tax. They've given you net profit which is before deducting depreciation and tax. So whether depreciation is required to be calculated in this question?
Yes, sir.
Yes, because there is a tax liability. Presence of depreciation will reduce taxation. And then they have given you two machine A and B, PV factor, compute NPV, discounted payback period. So in this question we will practice discounted payback period and we will also practice profitability index. So this way the 5 main methods got revised with the help of these two actual question, and this is a January 2021 exam question for 10 marks. Suggest purchase of which machine is more beneficial under discounted payback period method, under NPV method and under profitability index method. So you have to also reply which is better. So we will say in case of discounted payback period method, whichever is lower. In case of NPV method, whichever has higher NPV. In case of profitability index method, whichever has higher profitability index. Okay. So first I need to find out one thing which is common in all the answer, and that is CFAT. Yes or no? All three methods would require what? Cash flow after tax. And you are given net profit before depreciation and tax. So first you deduct depreciation, then tax, and then add back depreciation. Okay. One by one we'll have to do because it is going to consume some time. So this is a problem of mutually exclusive proposals. Are you ready? So first you write down step 1. Step 1. Calculation of CFAT, calculation of CFAT of machine A. Calculation of CFAT of machine A. So write 4 columns on the right side: year 1, year 2, year 3, year 4. $10 question in the actual exam of the institute. Why it is written January exam? Our exams are usually in May and November. That was an unusual year. Corona impacted year. Okay, so the exams were delayed by some months. So first you write down PBDT, profit before depreciation and tax. Preferably do not use short form in the exam. Preferably do not use shortcut in the exam, short form. Write down full. So this is your PBDT which is given. So less depreciation. What is the cost of this machine A? 8 lakh, life 4 years. Scrap value 0. So can I write 8 lakh divide by 4 years? Income tax. What is income tax? What is written in the question? Which method of depreciation is written? Whatever is given in question, follow that. If two methods are given, then take income tax method. Okay. On your own, do not apply your knowledge. When the problem says only one method of depreciation in one question, that will be required to be used. I had given you a note that if two depreciation rates are given, one under books of account, one under tax law, then use depreciation rate as per tax law. Keep the whole paragraph in mind. Don't select few words and then understand. So next point, write down PBT. PBT, A minus B. Anybody wants to reply? 30,000, 40,000, 20,000, 3,60,000. Point number D, tax at the rate of 30%. So 30% of, write down on your calculator 0.3 into 30,000. 9,000. Now just press 40,000 and press equal to. You'll get the magic 12,000. Again 20,000 equal to 6,000 rupees. And 3,60,000 press equal to 1 lakh 8. Wait a minute. Point number E, write down CF80. Now you'll wonder, how will I get CF80? I have not written PAT. I have not written add back depreciation. This first line is my PBDT, means cash inflow. It is basically sales minus your cash expenses. Okay. So that is cash inflow. Depreciation is a non-cash column. PBT is non-cash column. Tax is an outflow. Tax is outflow. So can I write A minus D, or suppose you are not convinced, C minus D plus B. C minus D will give you PAT, and PAT plus depreciation. You will get same answer. You can try. So first you try 2,30,000 minus 9,000. Okay, try one more. 30,000 minus 9,000 plus 2 lakh. You will get same answer, but that takes less time. The first method takes less time. A minus D will take less time. Next one, 2,28,000, 2,14,000. Last one, 4,52,000. Now write step 2, same thing. CF80 of machine B. Keep understanding, keep writing. Write down year 1, year 2, year 3, year 4. So start first point A. PBDT. How much is PBDT for machine B? Anybody? First year. First year PBDT. 1,75,000. 1.6 lakh. I don't know what he's saying. It was only indicator of lack of concentration. Okay. your life is revolving around that Instagram and whatnot.
3 lakh 20, 1 lakh 50.
So teacher is asking PBT, student is asking investment amount.
What man?
So less depreciation. What is the initial investment? 6 lakh.
30 lakh.
What is the life?
4.
4 years. There is no scrap value. So whatever method they will give you, follow that. Is it 1,50,000?
Yes.
Don't apply WDV if not specifically mentioned.
Yes, sir.
Okay, income tax law may require, but the question does not mention WDV purposefully because it consumes lot of time for a student in the exam. Then you write down PBT
25,000.
25,000, 1,10,000, 1,70,000.
1,70,000. 0.
Zero point buddy. Tax at the rate of. Take on your calculator 0.3 into 25,000. 7,500. Now 1,10,000 into 0.3.
33,000.
33,000. Wonderful. Then next column 51,000. Last column I will tell you. Zero. Without calculator. See
Yes, sir.
my power. I can calculate without calculator. Now write down CF80. Same format, A minus D. A minus D will help you to do it faster. 167,500. 2,60,000 minus 33,000. 27. 2,27,000. 320 minus 51. 269. Last one, 1,50,000. So first you do this basic working, which will give you CF80. CF80 can be A minus D or C minus D plus B. Wait a minute, on the screen, I have to compute NPV, I have to compute discounted payback period. Is it right? And I have to compute profitability index. What is common in all the three? We need to find out PV of cash inflow. We need to find out PV of cash inflow. Outflow is only this much, 8 lakh and so I will design the format in such a manner that it gives me all the three answers in one table. Do you agree?
Yes, sir.
So I don't have to prepare separate working note for NPV, discounted payback and profitability index. So write down in the same format we'll get calculation of NPV. Write down discounted payback. With practice we'll get such ideas that you can save time in the exam. Otherwise you'll have to prepare separate table for each of them. Okay. Say yes. First column write year. Year column is common for both. Then write machine A. Under machine A, we have three columns.
Yes, sir. I got it. How will be the format?
Cash flow, present value at the rate of what is the discount rate in the question? Any idea? 12%. So present value at the rate of 12% and discounted, write down discounted cash flow. Discounted cash flow. Now write down machine B. Under that, cash flow, present value at the rate of 12%. Last column, discounted cash flow, or you can write discounted present value. So this time write down year. How many years are there? 4 years. So first we will compute PV of cash inflows. First we will compute PV of cash inflows. How much CF80 you have computed in the previous table for machine A? Go to previous table. Machine A, last line, CF80. Oh, no.
What do you want?
What do I want? I want this line. I want this line.
2,21,000, 2,15,000.
Wait a minute. Who requires total? Do I have to write total or I have to write year wise?
2,21,000,
Okay.
2,28,000, 2,14,000.
Take it from the previous working notes. Okay. Go to previous working note of machine A. You will find in the last line we have computed CF80. Now it is right. This line on the screen once again. And for machine B also please reply.
Sir, 1,67,500.
167,500. 2,27,000.
It is 2,65,000.
2,69,000. 9. Yes.
1,50,000.
Wait. This is first you copy from there. Now listen to me. You have to find the present value at 12%. So type 2,21,000 divided by 1.12 equal to divide by 1.12 equal to memory plus how much is memory plus? 197,321. Okay. Now 2,28,000
194.
divided by 1.12, 2 times equal to 181, 68, 60, memory plus 2,14,000 divided by 1.12, 3 times equal to equal
152,321.
152,321 memory plus 4,52,000 divided by 1.12, 4 times equal to
287,254.
287
287,254.
memory plus memory recall
8,18,657.
8,18,000.
657.
Okay, no problem. Now we'll take cumulative values. 197,321. This is for discounted payback period. Okay, next one. Add please. Next one. 3 lakh something.
3,79,081.
379,081.
081.
Very good. Next one.
531,402.
531,402. Next one.
818,656.
818,656.
656.
Don't take total, not required. How? These are two different. Okay, make it 7. These two figures must be same. Okay. You are doing the same thing. Okay, no problem. No problem. Let us move ahead. For 1 rupee, we will not fight. We have so many other things to fight for. So write down this 167,500 divided by 1.12 equal to, and memory plus also 160
149,554.
554 memory plus 2,27,000 divide by 1.12, 2 times equal to 189,63 memory plus. Memory plus function will save time for calculation. 2,69,000 divided by 1.2.
191,469.
191,469. Wonderful, amazing. Memory plus 1,50,000 divided by 1.12, 4 times equal to. Again.
95,328.
95328 is right. Memory plus memory recall.
Sir, 6,17,313.
6,17,313. This is PV of cash inflow. Okay, now for discounted payback period, I need to compute the cumulative cash flow. You write here the word cumulative. Cumulative word is not written. Cumulative. And here also write down cumulative. Cumulative discounted cash flow.
Cumulative.
Or just write down cumulative present value. Anyway, can you just add these two numbers for me?
Why not, sir?
Yes, come on.
3517.
3
3517.
3517. Okay, wonderful. Next.
521986.
521986.
Yes.
Okay, again, come on. Next.
And that is last one.
It should match with this number. Both are same.
617313.
617313. Please take total properly. Please take total properly. If you can't take total, you will make faltu mistake, unnecessary mistake. That will cost you a lot.
6 months.
Okay. Now write down NPV. NPV machine A. NPV for machine A will be 818657 minus initial investment was 8 lakh. So it will be 18657, no problem, plus minus 1. And machine B write down. NPV machine B 617313. Can you see that?
17313.
Minus how much?
6 lakh.
Minus 6 lakh is right.
And which is equal to 17313.
17313.
313. Which is higher than
Right below decision based on NPV. So if you have to take a decision on the basis of NPV, which one will be selected? So write down machine A. Machine A will be selected. Machine A will be selected as it has higher NPV. Machine A will be selected as it has higher NPV. Wait a minute. Up to this you have written. Then I am going to erase now.
That's okay, sir.
Then write down below. Next question is discounted payback period. Go according to question.
Payback period.
So write down discounted payback period. Answer B.
Discounted payback period.
Discounted
Machine
payback period dash
initial investment.
machine A. Now we have invested how much? 8 lakh
Initial
rupees.
investment.
Wait a minute. We have invested 8 lakh rupees.
Yes, sir.
Go to this cumulative discounted cash flow column. You have to find in which year you have recovered 8 lakh. So it is recovered between year 3 and 4. More than 3, less than 4. Yes or no?
Plus
So I will take 3 plus
8
in
minus
bracket.
531.
I have to recover 8 lakh minus 531402 I have recovered, divide by this number 287254. Come on students.
287.
28725. This figure which I am circling right now.
Sir, it's 0.935.
3 plus 0.935. So 2.935 years approx. Write down.
935.
Yes, 2.935 years approximately.
Is that, sir?
3.935 approximately.
Machine.
And write machine B.
Initial investment 6 lakh.
So here we have invested 6 lakh. So again we will just understand last column on the screen.
3 years.
I have recovered in 3 years time 521,986. So 3 years plus initial investment 6 lakh minus recovery in year 3 521,986 divided by recovery in the 4th year is 95 3 to 8. Calculation must be done fast.
3.818.
3.818 years. Right, approximately. And you please write one note. I am going to dictate.
Sure, sir. No.
Note, write down.
Machine.
On the basis of discounted payback period. On the basis of discounted payback period. Machine B should be selected. Machine B should be selected. Machine B should be selected because discounted payback period is lower. Because discounted payback period is lower. Understood?
Yes, sir.
Because discounted payback period is lower. Now, I am going to erase again. Do you have any objection?
No, sir.
No. Even if you have objection, keep it with yourself. Okay. Now next is
Profitability.
profitability index. Write down point number 3. Profitability index. First write formula is equal to PV of cash inflow upon PV of cash outflow.
For machine A.
Done. Below that write machine A is equal to,
81865.
can you see 818657 on the screen? Inflow upon 8 lakh. Upon 8 lakh. Come on. 1.0.
Sir, 1.02332.
1.023. Okay, 1.023. Below that write machine B.
Sir, it is 6,17,000.
So you will write 6,17,313 divide by 6 lakh. 1.028. 1.028. This is higher.
2815 machine B according to note.
So this is higher. So now again write down on the basis of profitability index method. On the basis of profitability index method. On the basis of profitability index method, machine B is selected as PI is higher. As PI is higher. So you have learnt with the help of this example how to compare 2 or more projects and take decisions. Understood? Any query on question number 47, which was an exam question for 10 marks? Okay. So now we'll take a break.